Welcome to the Commercial Real Estate Report. We empower you to build generational wealth with real estate here. I'm your host, Chris Berg. I'm the head of business development for Abernathy Holdings. We go out and we build Class A self-storage sites in California, Arizona, and soon to be beyond. In fact, we sent out our first LOI to a site in Florida. So hopefully we'll be East Coasters soon as well. Special guest joining us today. He's the chairman and CEO of Abernathy Holdings, Andrew Abernathy. Andrew, great to see you.
Hey, thanks so much for having me on.
I'm excited. I want to touch on a lot of different topics, and I want to start with over the weekend. You were in Omaha at the Berkshire Hathaway annual shareholder meeting. You've modeled, at least as far as our conversations, modeled Abernathy much after Berkshire Hathaway. So let's talk about the weekend first. What was your greatest takeaway from the weekend and why?
I love all the people that go there. They're all like-minded, and a lot of them are doing different investments and different businesses, and it's just really fun to hear all the different things that are going on. And there was no shortage of conversations because everybody had the same love for Warren and love for Berkshire, and just it was a great time. I always enjoy sitting in the audience and listening to Warren. You get there at 6 a.m. One year I actually was the first in line. I got there at 12:30 in the morning or 1 in the morning. Sat in line. The problem is I got too tired to listen to him talk the whole day, so that was silly. But anyways, got there at 6 a.m. this year. Got a good seat. He talks. Basically, it goes till 5 p.m. And there's some breaks there. But it was just good to kind of hear his reassurance on the things that we've already thought about is, he sold 13% of his Apple stock. And the gist of why he did it, he said, is because I'd rather take the capital gain now with taxes because it's inevitable that those are going to go up with the deficit. He also kind of reassured some inflationary pressures that'll be created from the printing of money. And anyways, I can go on forever. I'm sure we'll dive in more, but those are just some of the highlights. I can go on forever. It was a great time.
Yeah, I want to talk about the cash you're sitting on, but since you brought up the Apple piece, I thought it was interesting the way he framed it as far as, hey, look, I love America. We sent $5 billion into the U.S. government last year. I've got no problem with that. In fact, I'm grateful to be able to do that. And if 800 other companies did the same, not one American would be paying taxes. So just your reaction to that.
Yeah, that was kind of cool to put it, in that way, in those terms. I think kind of circling, answering that and also circling around to the tax increases. I think he's right. I mean, if you look back 1985 and before, income tax, capital gain tax, corporate tax, I mean, it was all a lot higher than it is now. And our national deficit, our debt to GDP in 1951, back when it was higher, it was about the same as it was now. 1951 to 1985, when taxes were still higher, we had the lowest debt in history. It was like 51% debt to GDP in 1985. Well, since 1985 to now, with lower taxes, here's our debt again. And I'm not saying it's just because of that. And I'm also not saying I love taxes. I'm like everybody. I love not to pay them. But it is interesting to see, and whether I like it or not doesn't matter. Warren and I both agree taxes probably will go up in the future here to help with this deficit. So it'll be pretty interesting.
This might sound like a bizarre question, but as you know, I've got a background in media, and for years when I was in the media, people kept talking about the debt and the deficit. Does it matter anymore? I mean, the Fed just keeps continuing to print money. Do those things really matter, in your opinion?
Yeah, I mean, I think Warren mentioned on stage too, and I've read in a few things, it's what's the alternative? I mean, it seems like a global problem. It's not like just the USA is sitting here by itself with a huge national deficit and ruining our currency. Everybody's doing it. So, yeah, I mean, Japan's really the only one that's kind of been an outlier lately. The world basically gave them the go-ahead to inflate away their debt, and you're seeing it with the yen-dollar conversion. Yeah, I don't know. I mean, again, I don't know what's going to happen. All I can do is plan for us and our investors, and that is, be ready for the devaluation of the dollar, be ready for inflation, be ready for higher taxes. And again, there's certain investments that do good and they do well in inflationary environments. And those are the places I want to be. I want to stack our deck to win and not swim against the tides. So I can't fix the global debt problem, but I can for sure invest accordingly.
So you bring up a really interesting point, because I think when you see high inflation, many times people are going to say, hey, cash is trash, right? And so the old Ray Dalio saying, and yet here you've got Warren sitting on, he says by the end of this quarter,
$200 billion
in cash. So one, What do you think his mindset is saying, okay, I'm going to sit on $200 billion in cash?
Yeah, cash is trash if you have with a wide paintbrush, especially in inflationary times. But when you look at the tiny timing of right now and what's been happening and what probably will happen here for a little while is you're going to have the repricing of assets. And remember, his cash isn't just cash. It's right now it's sitting making 5.4%, some short-term T-bills. And I think what he's waiting for is just for things to correct themselves. We're coming out of a low tax, low interest rate environment for a decade plus, and that has priced assets at a certain price. Well, when you raise taxes and you raise interest rates, it takes time for that to go through the system. And I think he's just waiting for everything to get repriced to then go back in. So I think long term, he agrees cash is trash, but short term, it's probably good to have some powder for this correction, you might say, or repricing. Is it a crash? Is it whatever? It doesn't really matter. It's probably going to be repricing. And if inflation's going up 5% a year, 4% a year, 3% a year, and the market or an asset doesn't go up at all, in theory, that asset dropped 3% a year. There's real returns and that you got to look at. Inflation adjusted returns.
It's been interesting to watch it because obviously his cash pile has been stocking up. It didn't just happen in one quarter. And then if you look back at last year from probably October up until just recently, I mean, the market's been screaming, right? NVIDIA hitting all-time highs. You got S&P well above 5,000. So it's been interesting to see him not be able to take advantage of those gains. Now I get when you're talking $200 billion, it's much more different to deploy that kind of capital.
$100 million a day coming in that he's got, it's growing at 100 million a day.
Than the average Joe. And so I frame it that way to ask you, because again, you've been following Berkshire forever. Warren Buffett's a person you look up to. If you were sitting on $200 billion, how would you deploy it today?
Well, that is I work with a lot less zeros, that's for sure. I think for now, we'll get
for now.
Yeah. And we work with way more zeros than we worked with 10 years ago. So it's kind of fun to learn slowly. I think that can be answered whether it's $200 billion or $200. I think the answer is kind of what we've done at Holdings, and what he's doing is, we didn't break ground on a facility from 2021 to 2023 because there was just too much euphoria in the market. We couldn't find deals that really worked. And our cash pile swelled to, I think it was 40 or 50 million at the peak there. And now we've been deploying it because now we're starting to find deals like this Glendale site you and I were just talking about offline. It's shovel ready. Guy can't build it, so we might buy it and break ground and build it for the right price. And what he was asking for the dirt 2 years ago is way different than what we're paying now. So again, it's not 200 billion, but we had 50 million. We didn't do anything there for a while. Now we're slowly deploying. I think our cash balance is down to about 23 million. And I think that's going to continue to be deployed. I think Warren's just waiting. And again, it takes a lot to move the needle. For us, as Warren says, it's a lot easier to manage $1 million than it is 200 billion. If you look at also book value of Berkshire, he's about 20-25% in cash. That's about the same in history. I mean, if you look at just the cash balance of doing this, but if you take cash to book value, it's really hasn't done, it's been about 20% most of his history. So it's not really an outlier for Berkshire's case.
Let's go back to the Glendale site because I'm curious. I want to talk a little bit about the real estate cycle and where you think we're at right now. Just before we came on here, I was going through Twitter and a couple of guys that are big in CRE talking about, hey, just keep tough. I know if you've been in the business now for a couple of years, it's been a rough past probably 12 to 24 months, but keep going because there is going to be another boom. What happened with the Glendale site? Where was it priced 2 years ago and where is it priced at today?
A couple of years ago, they wanted, maybe even a year and a half, they wanted about $4 million, and we would have had to buy it and spend until now, or 60 days from now, they're projecting to get it actually shovel ready. So you had the carrying costs. So we basically got an offer that, waiting to get the signature back, got the verbal, but sounds like $3 million, and we close that shovel ready. It's a bigger site as well. So, we're able to be in the higher teens IRR at today's building costs, at $3 million, and at current rental rates. If we would have bought this site a while back with carrying costs and extra costs for the dirt at $4 million, and then rental rates what they are and building costs what they are, that IRR maybe was 10% at best. So it's just crazy to see what patience can do for us. And we're going to break ground at the same time. But that project is going to have a high teen IRR compared to a 10 minus percent IRR, same project. It's just price you paid and how long you had to hold the dirt. That's the only difference, only variable.
You and I have read a great book about the real estate cycle, The Secret Life of Real Estate and Banking. Where do you think we are right now in the real estate cycle?
I think first I'm going to say nobody really knows, but I think this is the phase. It takes a long time for reality to hit sellers. You got a lot of people that are trying to hold out for things to come down, and now they're not talking about interest rate cuts this year, potentially. Starting to really stress people out, and you're really starting to see it now. So again, I'm not saying there's going to be a huge correction, depression. I don't know. Maybe there is, maybe there's not. Either way, we're going to be standing fine. But I do think that you're going to start seeing some of these assets repriced. I've actually talked to some people in different states, actually North Dakota, and there's properties out there that they got mezzanine debt on, they got bank debt on, and those things are starting to daylight here, and they're having troubles. They need to clean up their capital stack, and it's just going to get a little dicey. So I think we're getting there. If you would have asked me this a year ago, which maybe you did on this, and there's probably record of it, we can look back. I thought this realization to sellers would have happened a little quicker. But I guess, it's just taking a little longer. I'm really starting to see it. I can see it by our pipeline. So, we got a board in our office here it's basically all the sites we have in entitlement or construction. And then when it opens, it falls off. So that's our pipeline board. For the longest time, that thing sat around 60 to 80 million for months. It plateaued, and usually we're adding to it every month. And that's just because we only do deals that make sense. And now the last, I don't know, what would you say, 8 weeks, 6 weeks, that board now has got over $150 million on it. So it doubled. And that, to me, I can literally just sit in the office and look at that board, and I can tell you if things are correcting or not. And so you can add to this, but that must mean things are starting to open up if there's starting to be deals that we're putting offers on. So we don't just do it to do it. We do it to make money. So.
Yeah, no, I think you bring up a good point. I think the soil is softening, maybe is the way I would say it. I don't think it's completely softened. I still feel like there's some delta between what the seller's mindset is and, where offers probably typically are. But here in California, we're starting to see that soil soften. And like you mentioned, you're patient, you wait, you put in the offer that works for you, and you never know what can happen.
Yeah. Yeah. And that was, like I said, that was tough. It was us in this office and you and everybody else that's working on our team. We had to really test our patience the last 36 months. And today I'm really feeling the excitement around our office for sure. It seems like that wait's over and we're in business, and we've got a nice cash pile to deploy for years to come and invest into this next boom cycle, which I'm bullish on, because we're underwriting the projects at today's rental rates and interest rates and construction costs, and should only get better.
Yeah, and I think what's going to be really interesting as we go through, like right now, I feel like the power of compounding. You follow Warren forever. It feels like we're in that state right now. We're just building the relationships, and over time, it's just going to compound, where all of a sudden all these deals are going to start flowing into us. We're like, okay, deploy, let's go. Anything else you want to share from Saturday and the shareholder meeting?
Yeah, I thought that, again, I'm a Warren Buffett nerd, so I could dive into a lot of things that most people would probably consider irrelevant. But it was kind of fun to see Greg Abel up there and Ajit and some of his other managers that's going to take it over. It's fun to still see him pretty involved. The structure of one of the things that I found interesting was they were talking about, do the managers of your subsidiaries still call you Warren? There's call it 80 subsidiaries. So we had 80 ED presidents, they call them subcontractors. We're going to call them, but they were calling them frequently. And he said, yeah, they kept calling me, but I started not answering questions, but was very nice. And then eventually they just started calling Greg. It was a great transition. I thought that was kind of funny. That was his way of getting the transition done. Then I was kind of curious, well, geez, how often does Greg, or how often did Warren Buffett get these calls? And it was about once every 3 months. So he basically got a call a day, because if you have each one calling four times a year, 80 roughly. So yeah, that was just interesting. And again, pretty much irrelevant, but I thought that was kind of interesting structure management.
Anything that you took from the day, last question on this, anything you took from the day that had you see Abernathy Holdings through maybe a different lens or change your strategy a bit from a capital deployment standpoint? Anything like that happen?
Yes, more long term. So right now, Abernathy's an LLC, and we have 80 some partners, and we've never done dividends, so our book value is exploding, right? Because we're just doing retained earnings and building, same as Warren. One of the things I talked to a lot of people about there was not yet, but going to a C corp may be a good decision for us. Right now, all these cost segregation and depreciation we're passing to our shareholders, which we do want to continue for some time. This isn't something we're going to do tomorrow, but I'd say in 10 years from now, roughly, C corp could make sense for us, because having the depreciation from the self-storage business to offset against all of our operating businesses that we own, that's kind of similar to their utility company. Their utility company doesn't make crazy returns, but the depreciation offsets a lot of the earnings from the operating companies. And that could be something nice that would be held within the C corp instead of passing them away. So I put a lot of thought into that this weekend, and I think that's something that we may consider in the future for tax purposes. And it's going to be a lot easier on us for K1s, because that's getting to be daunting with all of the entities we have and all the investors. So that was something I had a lot of conversations on that.
So maybe one day you too will be sending a check for $5 billion to the federal government.
Well, it'll have to be more because inflation. Inflation adjusted.
Well said. Let's move. I guess real quickly, if anyone out there is saying, "Hey, you know what? I like what I'm hearing from Andrew. I want to find out more about Abernathy Holdings, possibly be an investor. Is that possible? Number one, and if so, how do I go about doing that?"
Yeah, so we haven't issued shares in quite a while. We probably don't plan to, but we always have investors that bought shares 10 years ago. They're retiring, maybe want to sell a few of them to go on a trip or buy that second home. And so we're always trying to keep our buyer and seller list kind of even. Usually we have more buyers than sellers. I'm proud of that. But if you ever want to get on that list, just reach out to me. I got a personal page through Holdings. It'll get to me, and I can connect you with anybody looking to sell. You got to be credited, qualified. Probably we're gonna go qualified, because we used to be credited. I always like the qualified. It's just one step higher, and then obviously get a board approval. It takes about 30 days to go through the whole thing, but you would be negotiating with the current owner of ours. So there's always opportunities for that.
Nice. All right, let's move on to more real estate self-storage stuff. As you look at the landscape of the self-storage industry right now, what keeps you up at night?
I stay up at night, just excitement, really, because by us not building anything the last 3 years, we are not I'm up at night stressed about what we underwrote. I'm up at night thinking, gosh, I love all the deals we have, and I wish we had more. So, I'm just thinking that there's going to continues to be more opportunity. I'm excited to see all the ground breaks we got. I think rental rates have kind of found their bottom in my mind. I'm hoping that people start getting used to this interest rate, start buying and selling homes, or things start softening a little bit with short-term rates, get this inverted yield curve over with. That could be next year, could be the end of this year. Nobody really knows. But like I saw today, refinance demand was up 5% just because there was a little blip in interest rates. It's just kind of funny. It doesn't take much, and it's becoming the new normal. Just like a seller needs to have reality hit them on price. Human nature is funny, and humans have short-term memory. Like in a year from now, people will barely even remember the 3%. It'll be a story. It's just, I think that's interesting. I'm not really worried about it. So I'm as bullish as ever.
You can just feel the pent-up demand in the housing market, right? Like whenever this dam breaks, I don't know what it's going to be, when that's going to happen, but boy, when it does, it's going to be really, really good for self-storage. You think that rental rates for self-storage are at a bottom? Why do you believe that?
I think so. You've got people, and again, that's certain areas we're looking at. There's areas in Phoenix I've seen, that there's a facility actually for sale. It's been open for a year. They can't get anywhere near stabilization. You look at the 3 mile radius, they have like 30 or 40 square feet per capita. I mean, they're trying to sell this thing. The offers they've got are well below building costs. It's a gorgeous building. It's just in the wrong spot. So when I say rental rates, I think have kind of firmed up, bottomed, I'm talking about the areas that we're in that have, 6, 7 square feet per capita. And I'm not saying that always ties. There's some areas that have 30 square feet per capita and rental rates are $3 a foot. But for the most part, our areas are pretty landlocked. There's not a bunch of extra dirt. There's not a bunch of facilities in planning or going to be opening soon. I don't see those rental rates falling much further than this. And if they do, we're fine. But, we're still above the 2019 peak prior to the COVID spike. And I just think if you draw a line from 2012 to now, you're going to have that COVID spike that's kind of above the line. I think that's probably the more gradual approach. I think we're going to get back to COVID numbers, but I think it's just going to happen over time, natural growth. The other thing nice about storage, and again, we've talked about inflation, rental rates and storage are repriced monthly, and that's really nice in inflationary times. The last thing I want to own is a 30-year lease CVS or something like that, because you're going to go backwards to inflation big time, unless you have CPI adjustments, but most people don't. Most people have a 1 or 2%, and that might not be enough. We'll see, though.
So very well said. I guess I'd love your assessment then with that frame around the strategy right now, for example, that extra space is utilizing where, hey, they're cutting public rates. So for some, it makes it tough from an appraisal standpoint with the bank. I want you to address that. But then also once they get them in, they start to really dramatically raise the rates on the customer. And there's some just chatter going around, maybe some state capitals with that situation. So one, your assessment on the public rates, getting the appraisals, working with the banks, and then two, from a customer standpoint, the rates being cut, but then dramatically being raised once they're in.
Yeah, so we have Public Storage brand our facilities. So the nice thing for us with underwriting, we have a little bit of a look under the hood with them, which most people don't, because it's really hard to underwrite right now. I talked to a lot of guys in the industry, and they're just like, underwriting the old way kind of got thrown out of the window there with this new pricing model. So we are fortunate to kind of have that inside look. So we're just kind of looking at like, okay, what's our negative cash flow going to be? And what's our stable rental rate after all the games are played? Where's our rate at in 5 years? And that's what we can underwrite the properties to. And again, we're just like everybody else. We're still trying to, redo that underwriting model, but I feel like we got a pretty good hand on it, especially with Public Storage kind of helping us with that end of the day rental rate when things are filled. As for, is it right or is it wrong? I mean, I don't want to say a whole lot on that. I mean, if there's rent control put into certain areas, then we'll just Public Storage and we'll pivot appropriately. It's a unique model and it's a sticky customer base, so I can see why they're doing it. But again, we're just going to underwrite with the information we have and the reality we have. And we're just very happy to have a major REIT with us and behind us to kind of, hold our hand a little bit through that process, so we're not alone.
Last question, if you will, share with us where you see things for Abernathy Holdings over the next 36 months.
I'd say I'd like to get our 28 facilities up. Maybe 30 sounds a lot better, doesn't it? Or 36, one a month. That sounds nice. Longer the call goes, the higher my goal. Holdings has a couple divisions. Self-storage is our largest real estate development. So I'd say, I'd like to get in there 36 buildings up, one a month. And our equipment business, dealership business, I'd like to raise our top line there near 40%. Looks like we'll hit near 25% growth there. We sell municipal equipment across the Midwest too. That's our second division. Again, we're kind of a Berkshire Hathaway where we have two divisions right now that we focus on, and as we continue to grow, we'll probably keep adding. But that's kind of the goals for both divisions on the top end for me.
You brought up the one a month. Maybe you and I have talked about this in the past, but I want to revisit it even if we have, because he's just such an important part of what we're doing here at Abernathy Holdings, and that's Gary Thoroldson. I had a chance to visit with his CFO a while back, and I know Gary's done incredible numbers, but then when it was broken down this way to me, I just want to get your reaction and give you a chance to talk about the partnership and the joint venture with Gary. So from 1982 to 2022, Gary, over 40 years, he averaged one new hotel a month. And I just think that is such a staggering statistic. It just shows how incredible of a builder and operator he is. So, what say you just about those numbers and about Gary himself?
They always say that you want to, hang out with people that are smarter than you, so you level up. That's Gary for all of us on our team, and it's big shoes to. I'm not going to say fill, but to try to match. But it's really fun to try. Like let's just say our JV partner built a hotel every year for 40 years, which is also still pretty amazing. You know, who knows what our mindset would be? Our mindset might be like, well, geez, if we break ground on 3 facilities a year, we're doing really well. If we break ground on 1 a month, we're even with them. And Gary and I are both friendly competitive. So it's like 1 a month, we're just getting started. So it's really cool to have a JV partner that has had that much success and was able to put the team together to accomplish that. Because as when you talk to him, it's about the team. And it's about incentivizing everybody to make sure they think like owners. And that's the secret sauce. And building a really good product with a really good brand and a printable model. And that's what we're doing here at Holdings. And it's so cool to see that and then be able to be that close to Gary to kind of help him teach us how to do it and have him be part of every single one of them. It's just a pinch me, I'm dreaming moment every single day.
So one last story about Gary that I want to have you comment on. And the three of us were on a phone call recently, and I don't want to talk about the specifics of where, but I got to say, Andrew, one of the things that I just loved about that conversation was we were talking about a site. Gary's been doing this for a while, right? So, I mean, he could easily walk off into the sunset.
Oh, yeah.
But boy, you put a piece of dirt in front of him and some different ways to try to get a deal done. And you could just feel the passion. He's like, well, what if we did this? And what if we skin the cat this way? And we try to I just sat back from him and just watched him try to wrap this thing in several different ways to try to get it done. And it was really a treat, like you talk about his mentorship, to see him see the situation through several different angles so quickly, and he's not 35 anymore. I don't know how old he is. He's not 35, right? So just your reaction to that conversation, because we never talked about it.
Yeah, he's 77 now. I think it's just like the advice you should give your kids. Like if money wasn't a thing in the world, what would you do? And their answer would be something they love. There's a reason Warren Buffett at 94 in August, there's a reason he's still going to do what he's doing every day, because after 10 million or 100 million net worth or whatever the number, for sure 100 million, you don't need more money. I mean, if you're not, you could literally live and do whatever you want with that. And so, I mean, Gary could have stopped decades ago and Warren Buffett could have stopped decades ago. But when you do what you love, that's everything. I mean, that's like a child. And so the nice thing is I have that. I feel like you have, I feel like everybody on our team has that, where we're here because we want to be, we love it. And we do what we love. We do a really good job at it. Money will follow. And so it's just really fun to see guys like that, like Gary, 77, I think he is. And just, you see some people that are miserable at 77. I'm just like, I don't want to get old. But then you see guys like Gary. It's like, I'm not wishing my life away, but it's like, oh, I got a lot of happiness left. A lot of years to be happy. And it's just really cool to see it. And it warms my heart. And it's just fun to be a part of it, really.
Such a great point. I think that was the treat to watch, Warren and Charlie do their dance every year. I mean, Charlie was, I think, 99 at his last shareholder meeting. He was up there still having a good time and having a blast. So, want to be respectful of your time. Just want to give you the last word. Anything else you want to add or share?
No, I'm really excited. Like I said, I mean, it's been a lot of patience the last 36 months, but we are going. I am giddier than I've ever been. I mean, I am speeding to work. I'm surprised I haven't got picked up every morning. I'm just excited to get back at it. I mean, sites are coming in. Everybody's excited. I'm ready. I'm ready to invest into this correction or whatever it is, and I'm ready to come out the other side a big winner for us and our shareholders.
If people want to get a hold of you, what's the best way to do that?
I'd say andrewabernathy.com. You can there's a contact me, goes right to my email. And Holdings, I think that goes to you, Chris. But I'd say one of those two ways, abernathyholdingco.com. Those two ways would be best. And I'm also on social media, Andrew Abernathy. Don't forget the EY. It's a silent E.
Andrew, thank you so much for sharing your experience on Saturday, the vision for Abernathy Holdings, and I'm with you. It's an exciting time for us. And thank you, everybody, for joining us here. Be sure and share this podcast with family, friends, colleagues. This is the Commercial Real Estate Report, empowering you to build generational wealth with real estate.